Ladies and gentlemen, hello and welcome to us here at ATFX. My name is Philip and I have once again the pleasure and honor of being your presenter for this webinar. Tonight we want to focus on Forex markets and we want to see what those markets are currently doing. If you have a look at your webinar interface, let me just switch the focus here. If you have a look at your webinar interface, you should be able to see now the screens changing and you should see that small questions box. And right now, I would appreciate a very short yes or why in that box to just let me know that we have sorted the technicals out, that you guys can see the screens changing, that you can hear me well, and so that we're up and running essentially. All right, everybody. Thank you very much for the feedback. Really appreciate it and appreciate your help here. Tonight's webinar is scheduled to run for around about 1 hour. And of course, before we get started, you already do see those first risk disclaimers here on the screen. I have to make you aware of those. So please take a moment of your time to read through those carefully. Make sure that you're comfortable with them before continuing with the webinar. Essentially, this says that trading, of course, involves risk, and you should understand those risks, and especially the risks associated with the instruments you're using before you're getting active in the market. As neither ATFX nor Trade with Position nor myself are registered investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only, especially true for the live part. For the main part of tonight's webinar, we will be looking at the markets together, and I want to explain to you guys how I read those charts and what it is that I'm seeing on those charts and how I personally arrive at my trading decisions. Now, I don't have a crystal ball, which means I have no clue if that next trade will be a winning trade or losing trades. And let me be absolutely clear and frank here. There are losing trades. There are many losing trades. So if there are losing trades, if we really can't tweak those things in our favor, how can we make money as traders? Well, we can tweak things. We can start to think in probabilities. And this means that we have to think about not one trade, about the next trade, but we have to think about the next 100 trades. And with a proper trading strategy, following the same process, we can start to tweak the odds. And this means hopefully winning more often than we will lose and winning larger, winning bigger. Those two things are somewhat in our control. And this is how pretty much every professional trader makes money in the market. So it's not about the next trade. And coming back to this risk disclaimer, it just means even if I like that chart, even if I describe the perfect setup to you, in the end, you must own your trading decision. You must come for yourself to that conclusion that this is a trade that you want to place. And you have to perfectly understand that that trade could be a losing trade, even if it was a perfect trade to begin with. Alfonso is asking, and thank you very much for that question. And please, by all means, guys, keep the questions coming. Alfonso is asking, is this good for traders that are beginning in the market? Personally, I would think absolutely, because officially the agenda is we want to have a look at the markets together. And I should describe to you guys what I'm seeing on those charts and which markets are moving right now. Personally, I feel this is rather a little bit dull, a little bit unfair, because just because I tell you I like that market, first of all, I could be completely wrong. And next of all, the very moment I'm offline, you have no clue what to do next. And therefore, rather, I would like to show you guys what's going on inside my head and how I read those charts and how I arrive at my trading decisions. And once you understand that train of thought, that process that is going on there, I feel there's a lot to be learned and a much better understanding about what it is that you see in those charts. Suddenly, those are no longer just some fancy lines and magic blinking indicators, but rather all that stuff starts to make sense. And so, Alfonso, if you're just getting started right now, I think that's pretty much the sweet spot to be, because this is not just buy this, sell that, but rather how can we look at charts to improve our odds of becoming successful traders in the markets. Alfonso, I hope that answers your question here. That being said, let's just have a look at the markets. And then all this webinar is completely done on the MetaTrader 4 platform. So let me just quickly switch back here to the platform. And guys, first of all, what is it that I see on that chart? Right now, I'm looking at the British pound against the US dollar on a daily chart. This could be pretty much any market and could be pretty much any time frame. The big idea here is that our strategies that we teach here at Trade with Position are trend following strategies. And this means I want to see a market which has started to move. I do not want to pick the top. I do not want to pick the bottom. Far too risky for my taste. Can it be done? People tell you they can do it. And if they tell you so, probably they are right. I don't know. I do not want to suggest that that they don't speak the truth or anything else. And one more thing, let me completely be open here about this. What I'm teaching you here is what we trade every single day at Trade with Position in our very own private accounts. This is our style of trading. We do not want to suggest that this is the best style to trade. We do not want to suggest that that's the only style to trade the markets. Absolutely not. The beautiful thing about trading is you have so many different ways to be successful in the markets in the long run. You just have to pick the one that suits you best, that you like best. Our style is trend following trading, and therefore we don't want to trade when the market is doing nothing, when the market is range bound. And this is what I want to see. And currently the British pound is rather weak. A lot of markets or a lot of currency pairs involving the British pound are currently moving. And this is when I start to see structures like those over here. Let's just make this a little bit larger. First of all, I'm looking here at candlestick charts. Those candlestick charts do not just show me the closing price as a line chart would do, but rather they give me 4 data points. They show me where the market opened, they show me where the market closed, and the high of the low of each of those sessions. Right now we're looking at a daily chart. Way to read those charts, just the same thing on a 4-hour chart and so on. Now, the big idea here is, why do we even look at charts? My professors back at university always told me technical analysis doesn't have any merit at all. It's just wasted time. It's just like observing animals in nature and trying to predict the outcome of the next elections based on that. No merit in that at all. I didn't agree back then, and I completely, fully disagree right now. Why? My professors told me that the price is pretty much random. You can plot a random price distribution and this would result in something very similar to what we see here. However, they only ever used line charts, first thing. And the next thing is, we are not looking at price. I mean, we do, but price is not coming from out of nowhere. Price is the result of people acting in the markets. So when we see this candle shooting up here, opening here and moving all this way to the upside, it's not that those prices came out of nowhere. People traded, people bought this market, people started to buy more, they became more aggressive with their buying, and more and more and more and more. We can just, we weren't sitting at the trading desk with those people who traded there. We were not able to observe those people, but what we are able to do is we are able to observe the price that resulted from their actions. And therefore, what we're seeing on this chart is a map to traders' behavior. We see on that chart how all the market participants acted there and then. And that is why looking at charts makes so much sense. If we see that price has been moving in one direction forever, it's just like Newton's laws of physics. If something is in motion, it stays in motion. You've probably heard already also the term herd mentality. If everybody is running for the door, you might feel more inclined to run with the mass. And this is just going on within trends. If people have been selling more aggressively, they probably might want to do that going further. It takes more effort, coming back to Newton, to stop a motion. Same thing here. It takes more effort to step in front of that market moving down here and trying to stop that move to the downside. Therefore, we as trend following traders feel it's easier for us to just roll with what's already going on in the market. The picture I sometimes like to use here is that of a river. You have a broad, mighty river with a strong current. Do you want to swim against this current? Do you want to move against all those people trying to sell the market here? Or do you rather say, wait a minute, I can pick a safe location for me, just jump into that river and let that current carry me with it? Again, pretty much the same thing that we want to do as trend following traders. I'm waiting for a good location to initiate a position in the original direction of the trend. So talking about the trend, what is the trend? People will tell you you need fancy indicators for that. You need regression line calculations and I don't know what. No, absolutely not true. What you want to see is you just have to look at the highs and the lows. Simple as that. Trading, our style of trading is, some call it simple, I like to call it robust. Because robust means I'm not using something for which I need a computer. I don't need, everything that I do, pretty much I can do on the back of a napkin or with a printed chart. I can arrive at my same trading decisions right there and then. It's not about being fancy. It's not about having blinking charts. It's about robust techniques which focus on people acting in the markets, explaining why those people acted the way that they did, and then assuming that because they acted like that in the past, it's a little bit more likely that they will act in a certain way in the future. It's not about predicting market price. It's not about predicting anything. It's just about stacking odds in our favor. If we want to enter the market now, we can flip a coin. We can buy the market or we can sell the market. Our chance of success probably is something like 50-50. However, with every step of our analysis techniques that we perform, we are able to maybe tweak those odds a wee little bit in our favor. We are maybe able to move from 50-50 to 51-49, maybe 55-45, maybe 60-40, something like that. And guess what? This is good enough. This is good enough to make a killing in the market. Not on its own, but this is that's the first crucial component. The second crucial component is our risk-reward ratio, our reward-to-risk ratio. For every pound, for every dollar, for every euro that we are risking in the market, we want to be able to make a certain amount of money. Risking 10 pounds for the opportunity to make maybe 5 pounds is not what I'm looking for. If every time I place the trade, I run the risk of taking a loss, and I want to be compensated for that risk. And therefore, I'm looking at least for a reward to risk ratio on my trades of 1-to-1, which means if I'm risking 10 pounds on this trade, I want to be able to make at least 10 pounds on that trade as well. Now, how do we make money in the market? I don't know if that next trade will work out. I can just stack the odds in my favor, which means out of 100 trades, maybe 60 should be winning trades. Crucial. The second crucial component is my reward to risk ratio. If I now manage to have on average a 1.5-to-1 reward to risk ratio on top of winning 60% of my trades, this is how we make money in the market. And therefore it doesn't matter what the next trade will do, what the outcome will be. I know that I have to look at the next 100 trades. And don't get me wrong, I do not want to trade 100 trades for the sake of placing 100 trades. We do not want to generate business here and commissions for ATFX. The idea is we want to make you successful traders. And therefore you have to have a plan. You have to have a strategy to follow for those 100 trades. And I only want you to place the very best setups that you see according to those strategies. You want to have a repeatable process, and only then that built-in edge, winning more often and winning larger, is able to manifest itself. It's not about one trade, it's about a large sample set of trades. So how do we tweak those odds? How can we stack the odds in our favor? We look at the market, we look at the chart, and we are able to identify certain things. First and most crucial of all is I want to see a good trending environment, and I want to see optimal chart structure. What is it that I mean by optimal chart structure? I want to see charts like those here. The candles are sitting just next to each other. No nasty surprises, most of all, no gaps. The gap would be if the market closed at a certain point and opened way below or way above where the previous session closed. And that's the beautiful thing about Forex. With Forex, usually you don't have those gaps. Yes, the market can move fast, you can have slippage, and also definitely there are times when the market, even when Forex, will start to gap, especially of course over the weekend because the markets are closed there. But apart from that, Forex usually gives us a rather good optimal chart structure. So this is one thing that we don't have to worry about that much when we talk about Forex. Candles next to each other and a trending environment. And I do have a trending environment here. I can see the market made a high. We moved to a low and we pulled back to another high, but this is now a lower high. And price pushed lower to create another low, and this is now a new lower low. So I know at that stage that this market here is in a downtrend. Lower lows and lower highs, it's a downtrend, simple as that. If we move to, where is it? Let's pick, why not? Let's pick the S&P 500 here for a moment. Same story here, but obviously for an uptrend. Higher highs in this market and higher lows which go with them. Simple as that. I don't need anything else. And I don't have to know precisely, was this the high of the move or was that the high? Yes, this is clearly a new high here in this area somewhere compared with the previous high and the one before it. Simple as that, robust. So higher highs and higher lows in an uptrend, or lower lows and lower highs in a downtrend. First thing to note. Next thing, what are those fancy lines that I see on my chart here? I'm looking at moving averages. It doesn't matter if we use simple moving averages here or exponential moving averages. Why? Usually people start to trade off those crossovers, and sure enough, it makes a difference if we use a simple or a faster moving exponential moving average. This is not how we use those moving averages. We use them in two ways. The first way is I want to see before I explain it, just look at what those moving averages here have been doing here in this area and here in this area. And now compare it to the structure that we see with those moving averages over here. I'm looking here at a 10-period moving average, which is the black line. I'm looking at a blue moving average, which is 20 periods. 50-period moving average, which is the red line, and the green line is a 200-period moving average. So very slow moving, some mid-speed, faster, again faster. And what I see here is what we like to call a fanning pattern in our moving averages, which just means just take your left hand, your right hand, it doesn't matter, but spread those fingers out, stretch those fingers. And the way that those fingers are now pointing away from each other, this is pretty much the same structure that we want to see with our moving averages here when we are trend following traders and when we're looking for trending environments. Obviously, this series of lower lows and lower highs is what has created this move, and also which has created this fanning pattern in the moving averages. So this is not some magic indicator. It's obvious that the moving averages had to look the way that they do. So why do I even have them on my chart? And by the way, this is not only true here for those moving averages, but also for MACD and for RSI. All those indicators are calculated based on price action. So this means all the data, all the information that is already within price action is pretty much the same information that those indicators can show me. Calculations, transformations, they can't create new information. It's just a different viewpoint. It's just a different angle on that data. They make it easier for us to spot certain aspects of price action and price behavior, but they never ever are able to be that magic bullet, that one indicator that changes the whole game. No, it's all in price action already. Indicators are just a second level confirmation, or as we like to call it, the icing on the cake. So yes, I know that those moving averages should be looking like that after this move here to the downside. So why is it that I have them? Why do I have MACD? Why do I have RSI? Because it helps me with my scanning efficiency. I can look at that chart and immediately see, wait a minute, that seems to be a trending market. And that trend it must have been going on for some time, because otherwise I wouldn't see that structure right now. This is a somewhat well-established trend at that point in time. Otherwise, those moving averages wouldn't be here. Simple as that. I don't have to identify the lows and the highs and arrive at the conclusion it's a trending market. I immediately see it I immediately have at least a very strong guess just by looking at those moving averages here. If you have a watch list of about 10 markets per day, that's not a big issue. You can easily look at the highs and lows and arrive at those conclusions. But however, it's if you scan if you scan in tens or hundreds of markets, it makes a huge difference if you can just look at a chart and see, yeah, interested or no, just carry on. Nicole is mentioning that she has issues with the sound. Just guys, can you still hear me well? If yeah, just give me a quick ping, would be much appreciated. Better now. All right. Guys, if you happen to have questions or issues with the sound, the one thing I'm monitoring here my internet connection, and this is full throttle. Everything is going fine. If you have issues, the one thing that I can suggest is trying to log in once again, close the session, use the same link to sign up again, and more often than not, this fixes the issues. But thanks for that quick feedback here. So indicators help me to analyze charts faster. They help me to improve my scanning efficiency and looking at more markets in the same time. So fanning pattern in the moving averages. All right, there seems to be a trend going on. I'm interested now. I can see the lower lows and lower highs. I see the fanning pattern. First use of those moving averages. Trend identification with the fanning pattern. The next thing is price never ever is able to move forever in one direction. You always have this move of, let's call it 2 steps forward, 1 step back. One aspect that pretty much every trader, analyst in the market agrees upon is, yes, price is mean reverting. And this is just a scientific fancy way to say price and their moving averages, they will meet frequently. And this is what we want to see here. Price, obviously it's a downtrend. Price has been going down. Price has selling pressure. Just because this is a downtrend, do I want to sell this market right now? No, I don't want to do that. Why? Because I'm here overextended. And overextended here means I'm just too far away from the moving averages. I'm too far away from price equilibrium. And I can use my 10 period and my 20 period moving average here to help me to identify, to get a good idea about where those price equilibrium levels actually might be sitting. So if price is too far away from the 10 and 20, I'm not interested. It's just like with real estate or anything else. Just because prices are going up, do you want to buy at any cost? Absolutely not. You want to get a good deal. You want to have a sensible price and you want to have a good deal. And shorting this market down here, which means selling this market here to initiate your position, this is pretty much, this is not a good deal to be had. Why? Because people have been selling for so long and it's just like a marathon runner or sprinter. After moving in one direction, they have to pause. They have to catch their breath, and it's the same thing with the market. People have been selling all the time, and now it's time to catch its breath. And this means price is pulling back. Where is price pulling back to? Price is pulling back towards price equilibrium levels, my moving average sell zone in a downtrend, 10 and 20 periods. And let's quickly jump back here to the S&P 500. And same thing here, absolutely the same thing. I want to see the fanning structure in those moving averages. right here, the 10 is above the 20, above the 50, 200, all right. Now price pushes higher and it pulls back. Where does it pull back to? 10 and 20. And it doesn't have to be precisely within the 10 and 20. This is a somewhat fuzzy zone. In this move here to the downside, is this in the zone? Absolutely not. We're way overextended here. So do I want to sell the market? No, because I feel that this snapback to price equilibrium levels has to take place. Are we terribly overextended here? No, not compared with here. However, yes, we are overextended. I want this overextension to be fixed. I want to have a good deal. I want for price to pull back. And now here in this moving average buy zone, there I'm looking for potential trading opportunity. And you see that happening all the time. Pushing higher, pulling back, resting position. Pushing higher, pulling back, price equilibrium. Pushing higher, pulling back. This was a rather deep pullback, and then price continued higher, and again, and again, and again. Simple as that. I want to see that price is pulling back to price equilibrium levels to give me my potentially good deal. At least, even if the trade doesn't work out, I don't want to overpay for that trade. Coming back here to the British pound again. So I want to see a trend. I want to see optimal chart structure. I want to see a fanning pattern in my moving averages. And I now know in which area I might be interested to take a potential short trade or a potential trading decision. And guys, everything that I show here on the short side or on the long side just applies with, obviously, with changed directions to the other side as well. I don't care if I want to buy this market or sell this market. That strategy is the same strategy, the same settings on those indicators across all different markets, across both market directions, and across all different time frames. This means I'm looking at the 10, 20, 50, 200 here on my daily chart, on the 4-hour chart, and on the hourly chart as well. All those things, it's always the same because I'm always trading people's reactions, people's actions in the markets, and it's just what I'm seeing here. And you see that pattern here pretty much evolving across all different time frames. Here on the daily chart, yes, price pulled back and we waited here and then price stopped to the downside or moved to the downside. So can I trade this market here right now on the daily chart? Not so good right now, but let's drop it down here to the 4-hour chart. And guess what? This whole move to the downside on the daily, which didn't look that tradable. Same structure here, pushing lower, overextended, pulling back. Where do we pull back to? To the moving average sell zone, to price equilibrium levels, and we're good for the next round. And now price is pulling back. Where did we just pull back to? We just pulled back here to the moving average sell zone once again. So I want to get a good deal. A picture that you can use for this overextension is if you hold fast to an elastic rubber band and you take your other hand and stretch it. If you just stretch it a little bit and let it go, okay, it moves back to its equilibrium, its resting position. But if you push it back by quite or pull it back by quite a bit and then let it go, that's pretty hurtful when it snaps back. And it's the same thing with trading. We have moved away from the moving average sell zone here by quite a bit. And I'm always taking that risk of a potential snapback to equilibrium levels, and the farther away it is, the more hurtful that snapback will be. I don't want to experience that pain. I'm waiting for a good deal. I want to see that price is pulling back here, and then I want to enter that potential trade. Now, the question here was from Daniel, and thanks for that. Can you please confirm what you're looking for with MACD? We're using MACD and RSI in one specific way, and this is not the traditional way where we say we are looking at the crossover of the histogram here with the signal line. And guys, by the way, here MetaTrader 4 is, as far as I know, pretty much the only platform which just shows 2 lines of MACD. And pretty much every other charting platform has at least 4 different data points. But it doesn't matter because the only data point that we're interested in is the histogram here on MetaTrader 4. On other charting packages, it's usually not the histogram, but rather the MACD line itself. So how do I use my MACD line? I'm looking for, and let's try to draw that in here. This is a low, and this is a lower low. I have to have lower lows and lower highs in price if I'm in a downtrend. Most basic assumption, I have a downtrend and I'm looking for lower lows and lower highs. So I take this point in time where price made a low and that point in time where price made a lower low. And if I connect those points, obviously the line is pointing downwards. This is not a trend line. I'm just trying to illustrate that this is a lower low. And what I want to see with MACD is that at those same points in time, MACD also was able to make new lower lows. And I want to see again for those same points in time when price made the first low, I'm dropping down here, and I want to see that price was able to make new lower lows here as well. RSI was able to make new lower lows as well. This is called, we are scanning for convergence. Convergence means two different items behave in the same way. And this is what we want to see here. Price is making new lower lows and MACD is making lower lows. RSI is making new lower lows. This is a second level of confirmation. This is again something which could be seen just by looking at price action on its own. It's easier to spot looking at those indicators. This is a trend continuation. Not sure I want to call it a signal. It's a hint that the trend appears, it's a hint that the trend appears to be healthy, and there is nothing warning us that a new lower low might be unlikely in price. It might be different, and let's move here to the daily chart for one moment here. If we think that this pullback is over right now, which personally I don't think, let's scan for convergence here on this level. And let's just get rid of those lines here, not to confuse you guys. Where is my recent low? My recent low was here. And now I'm assuming that this could be my new lower low. All right, let's draw it in. I pick my line and I click here and drag it there and let it go. Lower low in price, exactly what I want to see in a downtrend. Now, at that same point in time, that was my value here at MACD. And if I now go to the same point in time here, I can suddenly see that those two lines are moving in opposite directions. My price line is pointing down. Price is making lower lows. But right now, if I really assume that that is currently the new swing point low and we start to pull back, I don't think it is. It's a little bit early to call for that. But if that was the case, I would see divergence here. Divergence means my indicators and my price action do not behave in the same way. And I like to compare that with, we are now with SpaceX. We're sitting at flight control and launch pad, and all engines go. We have about 10 more seconds to the launch of the rocket. And suddenly the first warning sign, LED comes off or goes off and tells me pressure in fuel chamber or rocket engine number 2, non-nominal. I know something is not right, and therefore I will abort the launch. Could the launch still be successful? Yes, but I do not want to risk that my money, I don't want to risk that rocket, the cargo, for something where I had an early warning sign going off. And that would be the case here, an early warning sign. And I think we can see this quite beautifully here again with the S&P 500. And it's still drawn in here. From that swing point high here to this swing point high, obviously this was a strong move. This was a really strong move. And sure enough, MACD was converging. RSI at that stage also was converging. Strong move, higher high in price, beautiful, perfect. However, the next pullback was deeper, a lot of turmoil here, We're looking at a weekly chart. And finally, however, price made a new higher high. Was this uptrend at that stage really looking healthy? No, it wasn't, because yes, a higher high in price, but definitely a lower high in MACD divergence, and clearly also a lower high in RSI as well. Simple as that. It's an early warning sign. I didn't have to wait for price. After this black candle here, I knew something. I knew, that's such a strong word. I had a decent idea that something was not looking up to standards, and it would be better advised to be cautious. And sure enough, price started to drop down significantly. And now here, a new higher high. And if we compare that new higher high here in price, yeah, pretty much the same level. So it's not terrible, but, and guys, again here, let's zoom in here a little bit more. If price is now about to make a new higher high, currently this is diverging. Yes, we haven't made the new higher high, but currently this doesn't look strong. If the market, however, now starts to rally and push higher and higher and higher again, and either moves up for a longer period of time or moves up in a short period of time pretty fast, this would fix that situation here. However, if now price is just pushing a wee bit above this all-time high at 2,961, something like that, let's say 2,970, and then immediately comes back, that's not looking strong. That's not looking healthy. And I can use my scanning for convergence and divergence to help me identify those potential situations. And it's not just MACD and RSI, pretty much any oscillator can be used for that. CCI, awesome oscillator, ultimate oscillator, they pretty much all do and measure all the same thing. They do it a little bit differently, but in the end, it's pretty much always the same. Using them as overbought and oversold indicators here. In a trending environment, you're looking for trouble, because in a trending environment, those indicators can stay oversold or overbought for way too long. That's just the way they're calculated. In a range-bound environment, however, those indicators can work just like a charm. You have to pick your battles. You have to think about if you want to be a trend following trader or a range bound trader. And then you can use those indicators that fit that style of trading, or at least the interpretation of those indicators that is a natural match for your trading strategy. Now, Neil has been saying that of our two indicators here, RSI is not showing divergence. Let's draw it in. First of all, let's draw it in and see if that's the case. And independent of that, if it wasn't the case, I'll answer that in just a moment. So we have a low here, and we're moving to this low here, and ever so slightly divergence. What I'm giving you here, guys, is a set of tools, a set of checkboxes. In the end, every trading strategy consists of different checkboxes, and you personally decide which of those checkboxes are important to you and which of those boxes you want to tick. Be consistent. If your rule says, I want to see clear convergence and divergence will keep me out of that trade, then that's your rule set. And this is then what you have to do every single time. Remember, one trade means nothing. We're looking forward to the next 100, to the next 1,000 trades. But the key here is to make that law of big numbers work for us, that we are consistent with our trading strategy. So this means if this is good enough for you here, it must be good enough for you, the same setting for all upcoming trades as well. Be consistent. How you want to use that, if you say that's crucial, that's not crucial, absolutely up to you. We have two core trading strategies here at Trade with Precision. And one is just to wait for a pullback to price equilibrium levels. Let's go back to this 4-hour chart here. And this is pretty much our bread and butter trade. We look for price to move lower and we wait for a pullback. And when we get the pullback, we're trying to initiate a potential short position here around those levels. Greatly simplified, but that's the big idea here. And pushing lower and now looking again to initiate a potential short trading position here around those levels. For that strategy, having convergence personally for me is a big bonus factor, but it's not crucial to have it. Our second strategy that we're looking at, and let me drop here down to an hourly chart, is a momentum breakout strategy. And this just means that we're looking for price to have established a flat horizontal level. And I want to see ideas that price is now about to break out from this level. And this is pretty much what we're able to spot here in this area. Let me draw that level in first. Levels are absolutely powerful tools. If I could go back in time and talk to my younger self, Philip, do you have one tip for me for my own trading, for our trading? I would tell myself, start to look for those horizontal levels of support and resistance. You see, let's zoom out even further. You see that price has reacted to this level here in the past, and precise touch here, and reactions here, and again, and again, and again, and again, and again, and here we get the breakout. Is this some kind of magical level? Where does it come from? Once again, we're looking at people's actions in the market. And if people thought that this would be a good price point to buy this market, they have initiated their positions here. If we're coming back to test those levels, the same logic might be applied. They might be defending their positions now. Pretty much here at that stage, everybody should have learned, yeah, wait a minute, price is bouncing off of this level. So maybe we should wait for a touch of this level and buy and try to capture the pullback, the rally that is going on here. But guess what? The very moment that price finally broke through this level here, we started to see those candles becoming way larger. Volatility is expanding. You can see this volatility compression going on here with the size of those candles. You see how small those candles suddenly become. I have my trending environment. I see lower highs all the way. I can see that my moving averages are fanning here. I do have a trending environment, but now we are hitting this level of support and resistance. The candles are becoming way smaller all the time. And we're sitting close to our moving average sell zone. Now we get the breakout. And guess what? Everybody who has been thinking, I buy the market down here because that's just trading on auto mode, it works all the time. Guess what? Here it didn't work any longer. And suddenly those people were in a losing position and the pain got larger and larger and larger. And so suddenly they started to dump, more selling pressure coming into the market, candles expanding, market moving down faster again. This is the momentum breakout strategy. Pretty much a very nice example here. And for our momentum breakout strategy, what we're looking for is, again, and this is absolutely crucial here, we want to see a chance for convergence as we get the breakout. Difficult to spot, but here it's really crucial. Let me draw this in here. Price touched this here first time, second time. So if I move this round about to those levels here where price was, we're sitting very, very close to those levels here on the second touch and on the third touch. And so the idea is, I do get the breakout. Do I think that it's likely that MACD would expand as well and give me a new low? Yes, absolutely. The one thing that I didn't want to see, and unfortunately I can't draw here on this area, but I wouldn't have wanted to see that MACD is pulling back all the way and is sitting here at those levels, maybe even above the zero line. And because then if we get the breakout, it takes much effort to make a new low here in MACD. So at that stage, MACD and RSI would be diverging. And this is a must-have for me for that trade. If I see that divergence, it keeps me out of the trade. The momentum breakout strategy must give me convergence. Daniel is asking another great question. What confirmation do you look for when trading a pullback in a trending market? Let's have a look here, maybe at a, let's go back here to the S&P 500. And guys, by the way here, 15-minute chart. You see those same structures, which I just have described all the time, or I am describing all the time. They happen pretty much everywhere. Every market, every time frame. This is now a 15-minute chart. Price is pushing higher around that point in time. The New York session opened, price pushing higher, going there, pushing higher, going there, pushing higher. Sorry, the Wall Street opened here at that point in time. But starting in the morning, and this was pretty much the market's reaction on Mr. Draghi's promise to print even more money and devaluate our currencies. Price is pushing higher, moving sideways. Where is it moving to? Moving average buy zone and trend continuation and so on. Now, what I want to see, and I didn't see that perfectly here right now. I did get that somewhat here, but here, let's try to go to a lower time frame. Maybe it's more obvious there. Just a moment. Yeah, all right. Let's take this one here, for example. Daniel, you've described perfectly that I want to see what I want to see. I want to see this pullback. And now I want to have an idea that this pullback might be over. I want to see a confirmation. It's not that I want to lean in and anticipate that that move might be over. I could do that. I could do that with Fibonacci retracements and trying to pick a level for a pullback that just makes sense. But for this type of trade, I'm looking for confirmation. And the idea here is, yes, price has rallied. We are overextended. I know that this overextension should be fixed. I know that I want to get a good deal. So I'm waiting for this pullback. And we're getting small candles here. And honestly, that candle could be smaller. It's not a perfect setup here. But with this candle, I see now a rather smallish, bullish candle. And I'm waiting for this bullish candle. This bullish candle here suggests to me that this pullback might be over. I'm waiting for this candle to finish printing. I always trade only based off finished candles. And once I get this candle, how could I trade this market and setup then? Well, first of all, where would be my entry? I think that this pullback is over, and therefore I would assume that price is now starting to push higher. I do not want to jump the gun. I do not want to take a gamble. I would like to see that the market is already moving higher. And therefore, I'm entering here with a stop buy order. I do not want to enter cheapest. I want to see that price is starting to push higher and is triggering me into my trade, into my position. So I'm entering with a stop buy order here, about 1 tick, 2 ticks. We're talking here about the S&P 500 futures minis. So 1 tick, 2 ticks above the high of this candle is my stop buy entry. Where is my stop loss? My stop loss, I assume that this pullback is over, and this pullback has given me now my new higher low in an uptrend. Therefore, I'm picking the low of this move, and this would happen to be either this candle or the one next to it, and same logic applies here, 1 or 2 ticks below the low. So that is my setup. Stop buy entry at this price level, sell stop. If price pulls back down here, I obviously haven't found what I was searching for, or at least my new higher low. Could mean the price is pulling back even further and establishes my new higher low somewhere here, or the trend could be completely changing. However, the basic idea for this setup was I have identified the swing point low, the new higher low, and I'm basing my trade on that. And if we drop below this level, that idea is gone, that assumption is wrong, and I want to be out. Simple as that. Remember, our trades must be comparable. It doesn't make any sense for me to have 9 winning trades out of 10 and win 1% of those on those trades, but lose 20% on the one losing trade. Same risk exposure for all trades. First of all, let's talk about position sizing for a moment here. First of all, I must distinguish between a money risk or an account risk and a trade risk. The one thing is, for the account risk or money risk, I must look at my trading account. How much money do I have in my account? For the sake of simplicity, let's just assume I have 10,000 euros in my account. I'm willing to risk round about 1% of my account on any one trade. And this means if my trade doesn't work out, I'm willing to say, all right, we are moving from 10,000 euros to 9,900 euros. Is it nice to have lost those 100 euros? No, I don't like that one bit. But does it prevent me from placing the next trade? Is it risking my trading career? No, absolutely not. You stay so small that it doesn't matter if you lose. We do not want to lose. We want to win more often than we lose, but we must make sure that we're risking the same, or that we take the same risk exposure on all of our trades. So I now know that this distance from this entry to this exit should be worth 100 euros. What I have to do now is I have to take this entry price, I have to take this stop price, calculate the distance, and then just play around with my deal ticket. Or of course, there are calculators out there, I can easily do the calculation, and I must transform this entry level and this price level to so many lots, contracts, shares, whatever you intend to trade, that this move here, being triggered in here, being stopped out here, is good for a loss of 100 euros. Now the position sizing is done. How do I manage that trade? Well, I could be going here for multiples of the risk. Remember, I wanted to have a reward to risk ratio of at least 1-to-1 or larger. One way to achieve that is to say, all right, I want to place my first profit target at the same distance, round about there, at the same distance where I not where I entered, but from where I entered, same distance to my risk. So if I'm triggered in here and I close my position here with a take profit order, this means that I will now have booked the same profit approximately than if I had taken that trade as a loss. Risking 100 euros, gaining 100 euros. And now advanced form of trade management is I could also be shooting for multiple profit targets here. And this is why small candles here are so crucial, because if that candle was smaller, my entry could have been maybe down here. So my first profit target could also already have been here. And I could have gone also for a second profit target. So, Daniel, coming back to your question, what confirmation am I looking for? I'm looking for a bullish candle, because bullish suggests to me that the selling pressure is gone and that the market, the pullback is over, and the market is continuing in the original direction of the trend. And I want this candle to be bullish in or very close to my moving average buy zone, and I want it to be a small candle. And because it's a small candle, I have definitely probability advantages also for my position sizing. I can trade larger, I can hit my first profit target earlier, and I can probably also hit my second profit target easier than if that candle was larger. If you think, on the other hand, let's get rid of that one and elaborate here on that position sizing for a moment more. People tell me, oh, this stop loss, that's way too close. I don't want to be stopped out. I prefer to give my trade a little bit more wiggle room. That's perfectly fine. But what are the implications here? This is my risk. And here on the top is currently my about 1-to-1 profit target. If you now say, I want to have a wider stop loss, I don't want to be stopped out, because so I'm shooting for a stop loss round about there. That's perfectly fine. But now to get a 1-to-1 profit target, I have also to move my take profit order somewhere here. Makes it more difficult for that profit target to be hit. Market has to travel more. I have to be not more right, but the market has to play along way more to give me that one. And therefore, no, I want to have my stop loss in a logical place. And preferably, this is a tight area between my entry and my stop loss, because this then gives me my profit targets faster and makes it more likely within my perception to actually be successful there with those trades. Now, AJ is bringing up a good point. This is a bullish engulfing pattern, and here in this example, you are absolutely right. This is a bullish engulfing candle or bullish engulfing pattern. However, I do not really pay attention to those patterns. What is more crucial for me is the structure of those candles. This here already is a very bullish candle, and yes, I can learn that this is now a hammer after this small move to the downside. However, I do not want you guys to learn those patterns, because yes, I hopefully appeared to be pretty knowledgeable right now, because I knew that this was a bullish engulfing and I knew that this was a hammer, but it doesn't mean a thing for my trading. It doesn't help me with my trading decision. I must understand what happened within this candle here and why this is a bullish candle. So what happened here? Price opened up here, and then there was a lot of selling pressure, which means price moved all the way to the downside. But ultimately, sellers were not able to maintain their momentum. Buyers came back, and buyers came back pretty strong, and they were able to drive price all this way back up here. And this is what created this longer lower shadow and the small body here sitting right at the upside. Think about reading those candles and the trend as some kind of storytelling exercise. If you're able to tell a story about what happened for the chart structure to look the way that it does, you have a pretty good understanding about what people have been thinking and what has been going on here on that chart. Same story here. Yes, I know that this is a shooting star, but again, I don't care, because there was a lot of buying. But just like here with the selling, the buying was not sustainable. For one reason or another, I was not there. I was not able to interview those people, but I see that at this point, sellers became more aggressive. If we had access to the executions here, we would probably start to see that sellers were not waiting for their asks to be hit, but rather the sellers became aggressive and started to hit the bids on those trades. And they drove price back down. A lot of selling pressure. Yes, the body is still white, the body is still bullish, but what makes this candle, especially here after this move higher, so bearish, is this long upper shadow, which shows me that sellers rejected all the buying efforts that have been going on here. This is how I like to look at those charts and the candles and understand what has been going on there. Question here, do start with daily time frame and then go down time frames for entry? That's precisely what I like to do for my own trading. I want to see what's going on here. And let's have a look at British pound, New Zealand dollar, for example. I'm looking for the daily chart here. Price has been going higher, but then again, once we start to see the selling pressure, this market is starting to go down. Is this now a well-established downtrend? No, it isn't. Compare the structure that we saw here with the structure that we had here with British pound against the US dollar. Way better established downtrend. So therefore, if I'm looking for a potential short trading opportunity within the pound between those two markets, currently my favorite would be the British pound against the US dollar. I get the big picture here. I see what the market is doing. Is it tradable here on the daily chart right now? No, it isn't. But I get the big picture. The 4-hour chart, yes, this is a nice, well-established downtrend here on the 4-hour chart. Now I have the daily chart to confirm my whole analysis so far. So what I would like to see probably is this 4-hour candle to turn a wee bit bearish or move higher a little bit, and the next candle to become bearish. If I get a small candle, just a candle like here, sitting up next to this candle right about there, that could be a very nice trading opportunity. Once again, I do not suggest that you want to take that trade. It's just for educational purpose, but I hope you get the picture. I want those different time frames describe that market setup. Think of a Scotland Yard inspector. He's rushing to the crime scene and he has several witnesses. If those several witnesses tell him the same exact story from different angles, but the same story, yes, the suspect left the crime scene in a yellow, I don't know, yellow Toyota, and the number plate was ABC. Okay, if this is what everybody tells him, he knows what he's looking for. He gets a consistent, coherent picture. But if every one of those witnesses tells a different story, one describes a male subject, the other one a suspect, the next one describes a female suspect, the next one describes a tall, the next one a small, or you get the picture. You want to see consistency. And if the daily chart is telling me, yes, I'm in a downtrend and I'm waiting for a nice trading opportunity, the 4-hour chart tells me, yes, I'm in a downtrend and I'm waiting for a nice trading opportunity. And for the hourly chart, the pullback is already too deep. So far, I'm looking here. If I want to focus further on that market, my best bet would be to say, I wait for that candle to finish and probably also for the next one, and then look for a potential trading opportunity there. I always start with the higher time frames and go down. I want to have a consistent, coherent story about what I think is most likely to happen. Guys, we're already a little bit over time. Sorry about that. Let me just quickly come back here and finish those few slides. Yeah, guys, if you haven't opened your account with ATFX yet, please consider doing so. Just some of the ideas why you could and should consider ATFX as your broker. Well regulated in the UK within with the Financial Conduct Authority, the FCA. You see the license number here. Funding and wiring money out of your account is as easy as can be. ATFX is committed to providing competitive prices for our clients. The spread is absolutely crucial. The spread is our cost of doing business. We want that spread to be as small as possible. Global investors most widely used trading platform MetaTrader 4, which we have just seen in action here today, and brilliant customer service, 24 hours, 5 days a week. Just in case you have more questions there on their services, give them a call. You see those contact details here, or shoot them an email. Feel free to do whatever you would like to do there. If you have questions on today's content, I'm happy to answer those questions as well. Right now, I'll give you a few more moments to type those questions if there are any. But so far, we seem to be good. Then, yeah. All right, John, thank you very much for the feedback here. The moving averages, I don't care if it's simple or exponential, because let's go quickly back to the platform here. The only thing that would change with my moving averages if I switched to an SMA or to an EMA would be that the location of my fan, the location of my buy and sell zone, would change ever so slightly, minuscule changes. Our suggestion is that you want to use both in the beginning. Experiment with both. See what you personally like best. This is just like anything else. Personal preference beats everything. And guys, if we use the 10, 20, 50, and 200 here, but you feel you're getting much better results if you're going for an 8 and 21, or if you want to shoot for FIP numbers here, 13 and 21, for example, by all means, go for it. What we want to show you here is a good starting solution, good starting point. but ultimately you will make those strategies your very own. So simple, exponential, you pick what you like best. The way we use them, interpretation just stays the same. And Daniel is asking about a pullback, if it is a pullback to the 10 or 20. Personally, I like to see a pullback which is sitting just in the sweet spot right here within that zone. However, a pullback here to this level, that's good enough. The zone extends a little bit beyond both the 10 and 20. This is not a precise price point. I have to see that touch even by the last pip. The big picture is important. I do not want to be overextended. I want that overextension to be fixed. It's fixed here, it's fixed there, it's also fixed back here. This is, again, comes down completely to your own preferences. All right, guys, let's wrap it up here. Thank you very much for tuning in. Thank you very much for your questions. There is a short survey coming up. Any feedback that you have for us is really appreciated. We want you guys here to leave and say that was an hour well spent, and please give us the feedback to help us to achieve our goals here with that regard. Very nice evening, happy trading over those next few days, and I'm already looking forward to welcoming you guys again pretty soon here at ATFX. Thanks again, take care and bye-bye.